This is the Gold Newsletter Podcast, your home for investment, economics, and geopolitics. For our publications and archives, go to goldnewsletter.com. This is the Gold Newsletter Podcast. Fergus Hodgson hosting here with Brian London back in New Orleans. And we are zeroing in on real estate this week. And we have Russell Gray. He is co-host of the Real Estate Guys radio show and radio and TV show. And he has been in the field of finance since the 1980s, faculty member of the California Association of Realtors, and he has taught finance. He's also a conference organizer or speaker, so he's been working in this field for a long time. And I should point out that he is a consistent attendee and presenter at the New Orleans Investment Conference. Russell, thanks for joining us this morning.
Oh, thanks for having me.
As we just discussed briefly through email, that there's maybe a lot of turmoil or growing turmoil economically in the United States, and we wanted to pick apart how that is impacting real estate. And of course, Puerto Rico has declared bankruptcy, or I'm not sure whether it's technically bankruptcy, but they've defaulted on their debts. And now Illinois is following suit to some degree. They've got so many back payments now, or so many penalties for late payments, and they're putting on a $5 billion tax increase on residents there, which equates to about $500 per person, and I assume per taxpayer more than $1,000. How do you interpret this maybe rising tide of government debt and therefore either defaults or tax increases?
Well, I mean, the big picture is fundamentally our system is flawed. And we've got a world that's awash in debt. And, anybody who's ever managed their own personal debt understands it's basically a function of income and interest rate. So you have a certain amount of income coming in that you can dedicate towards debt service. A lower interest rate means that amount of income or that debt service payment will control more debt. Well, when you've been for 30 years dropping interest rates and you've had debt growing faster than incomes, at some point, you're going to have a problem. And I think the world has kind of hit that. We've been bouncing off that zero bound for many, many years, and we're now slowly trying to inch it up. And, I've heard people make the argument that these modest interest rates that the Federal Reserve is making really, aren't exceeding inflation. So, in fact, it's still a net negative, and we still have loosening, even though it seems like there's tightening. But, for the average person out there, especially when it comes to real estate, it's the availability of mortgages, it's the interest rate of mortgages, and it's how much income do they have to qualify and to be able to service those mortgages consistently. And that's what we're up against. So we just got a great jobs report in the United States, at least allegedly. You never know if these things are actually accurate, but there's been a little bit of hoopla about it being a pretty strong jobs report, at least in terms of numbers. We still have a fairly low labor participation rate. I think it's a 50-year low, and that's a problem. And wages didn't go up as much as they had hoped they would go. So, and then if you dig down into that labor report and you look at the kind of jobs we're creating, the big chunk was healthcare, and next after that was professional and business services. The problem with creating jobs in healthcare, they're great jobs, but it's like creating government jobs. And, people who have them can pay bills, that's for sure. But as a country, are you really producing anything? Are you really manufacturing anything? So the mining sector, something that Brian knows quite a bit about, had a little bit of improvement, I think, with 8,000 mining jobs created. And that's been something the Trump administration has been focused on, trying to get us back in the business of actually producing things, mining things, farming, mining, manufacturing. And until those jobs are really being created in robust style, I don't know that the United States is ever going to be able to claim a strong economy, in the thing that really matters, which is productivity.
Russ, one of the things that I find you guys, you and Robert Helms, your partner in the Real Estate Guys radio show, one of the things you guys stress all the time is that in these investment markets, they're so volatile. People freak out over headlines. They go to and fro. But that you can immunize yourself from this by building income through real estate. And, in a minute, we'll go into how these trends actually affect real estate as well as precious metals, et cetera. But what you guys really preach is self-reliance and independence in building an income that insulates you from all of these extraneous trends that really are destroying wealth for some, and will destroy wealth for so many people. Can you talk a little bit about how that works and how real estate performs that function?
Oh, absolutely. I mean, and the thing is, it's really, when you hear somebody say it, it's so simple, but until you hear somebody say it, you don't think about it. And I believe our system has been configured in such a way that the big money players collect streams of income. Well, they convince the rank and file investor to try to buy low and sell high, which of course generates trading commissions for the Wall Street machinery. It generates capital gains, short-term capital gains, tax at ordinary rates for the IRS, and it produces cash, which gets parked in the banks. And so, everybody who's behind this machinery wins, except the little guy is in there swimming with sharks and trying to time the market and all that kind of stuff. And the bigger issue, and this is the fundamental flaw, is the way asset prices get set. And so many people don't understand this. Now, I'm going to use real estate as an example, but it's true in stocks, and I'll probably share that example as well. There's two methods of valuation. One is by comparative sampling, and that's the way most people get asset value. So they look at something on their balance sheet, and they go, the last time somebody who had something like this sold it, it sold for this price. Therefore, this thing sitting on my balance sheet, which isn't for sale, and there's no active buyer out there that I know of, but I'm just have it here on my balance sheet, and because the last time it sold for X, it's worth X, and so therefore, it has value. And then you subtract out whatever your liabilities are, and you look at your net worth, and you feel rich. And it's based on an asset valuation price. It was based on a comparative sampling. Now, in real estate, an appraiser can come in, and if in 1 square mile, which you can fit thousands of houses in 1 square mile, or a lot of houses. And so every single house, just to use a simple example, let's say you've got 10 houses in an area, and let's say in an economy, and there's only $1 million available in the whole economy. So just to make it really simple for the math, if you were to say every single one of those houses is exactly the same, every single one, exactly the same condition, same construction, same age, same everything, and you were to divide the amount of money available in the economy by the number of houses, on average, each house is worth $100,000. But because every house doesn't come for sale at the same time, then somebody puts their house up for sale, somebody really wants it, and they pay $200,000. Okay, well, to that buyer and to that seller, that house was worth $200,000. It's a real transaction, real money exchanged hands, and there's still $1 million in the economy, $200,000 on that house, and the other $800 divided by the remaining 9. See, but every other homeowner thinks their house is now worth $200,000. Well, if you do the math, you've got an economy now that's allegedly worth $2 million, but there was only ever $1 million in the economy. And so it's a comparative sampling. The one house is forming the valuation for the other 9. Everybody puts on their balance sheet the valuation of the one house that really sold, but we all know that if those houses were all to go up for sale, the price would come back down to reality. This is what happens when a bubble bursts. This is what happens when everybody heads to an exit in stocks or real estate or anything. Now,
this
if you
was
contrast
2008,
that,
in other words,
2008, 1987 in the stock market. I mean, you could go on and on. It happens all the time. The first quarter of this year, there was a big headline saying that household wealth in the United States went up by $2.3 or $2.4 trillion in 1 quarter. Well, did people really produce $2.3 trillion net after expenses? In other words, did they go work and create all that value and then save $2.3 trillion? No, of course not. See, that's just air on somebody's balance sheet. It's stock prices and real estate prices up based on comparative sampling. Income is different. So in 2008, housing prices, for example, dropped 40, 50, 60, 70%, but rents didn't. And the reason rents are stable is because you go to a community where there's 10,000 apartments, 90% of them are rented. And that means that every month there's a buyer and a seller exchanging real money, doing a real transaction at about a 90% absorption rate. So those are real comps. Those aren't just air. And so when you go into a situation as a real estate investor, any investor, and you value what you're buying based on the income it produces, and you're focused on the stability and the durability of the income, you have real value. It's like Warren Buffett, famous for being a fundamental investor, not a technical investor. He looks at fundamental earnings. Does this business make money? Well, same thing. Does this property produce rents? If it does, and you make a purchase based on a valuation of a cash flow that makes sense, a return on investment based on cash flows, you're going to have a more real valuation. And what's better is those cash flows are stable. So while valuations may go way up and come way down, if you just got that steady cash flow going and a positive spread on your debt, in other words, if you're cash flowing at 8% and the debt that you're using to control the property maybe costs you 4%, you've got a 4% positive arbitrage, if you will, on that debt. And if I can make 8% on 4% money, how much 4% money do I want? As much as I can get. But the key is making sure that you're not speculating with the money, but you're buying real streams of income.
I think that's a real key to what you guys say, is that debt isn't bad. There's bad debt and there's good debt, but debt overall is not bad. You see so many people preach get out of debt, etc. But you'd love to have a lot of debt if that debt was good debt and working for you.
Well, that's the key. It spreads. It's like banks. You look at banks, and banks are out there saying, hey, please deposit your money with me. Please deposit your money with me. Well, in the old days when they needed it. Right now they get all the money they need from the Fed. But back in the old days when banks had to operate like real banks, capital formation through savings was important. And so, but the issue is when you put your money in the bank, it's not an asset to the bank. It's a liability, because now they owe you the money at interest. And so the bank now has to create an asset on their balance sheet, which is a loan. So on your balance sheet, it's a liability, but to them, it's an asset. And so they have to create a positive spread. So if they can pay you, say, 4% on your savings and then make you a car loan at 8% or a credit card loan at 18%, well, they're making money on the spread. And of course, we know they use fractional reserve banking to lever up, so they magnify that by, up to 20 times. So this is, the danger in the banking system. And the reason the banks always get in trouble, and something an investor should never do, is to borrow short and lend long.
Yeah.
You want to do the opposite. You want to borrow long and lend short. Well, when it comes to getting cheap long-term money, it doesn't get anybody better than real estate. You get to put a 30-year loan on a real asset. You get to put a tenant in there who's going to do the debt service at a positive spread. You pick up tax breaks. And then if you wanted to, later when you build up equity, you can pull the equity out and you can do another 30-year loan, and you can go make a bunch of 5-year loans. So you don't even have to be on the equity side of the transaction. You can stay on the debt side. There's a lot of things to like about real estate. Anything you can do with a paper asset, you can do with real estate. You can do, you can create high income, you can create wealth preservation, you can be short the dollar, you can be long the dollar, you can create spreads. There's all kinds of things you can do. But most people don't understand it, because all of the financial education, and we don't get much financial education. Most of it is just marketing by people who want you to feed their machinery, as I mentioned earlier. But if you really get a good financial education, the concepts are not that complicated. I mean, I can teach them to an 8th grader, and they get them. It's
you do.
Complicated.
And you do, and you have. One of the things, I guess it was about 4 years ago, where you and Robert and I kind of discovered each other and kind of realized that our world, which is largely focused on precious metals and wealth preservation and wealth creation through precious metals, mining shares, et cetera, has really overlaps in a lot of ways with real estate, and that a lot of the economic trends that help one also help the other, and that it all kind of revolves around wealth preservation and creation as well in those kinds of circumstances and scenarios. So I got you guys to start talking at my event, and now I'm starting to talk at your events. And what I really like about being in the conference business, I recognize the value of getting fantastic speakers who really know what they're talking about, who have the experience, and who want to share that knowledge. And you have guys, and really that whole kind of ecosystem that you've developed through your radio show, through your conferences, everybody is so open and sharing. There are no secrets. There's no trade secrets that they try to keep to each other. You have people who have done it, who have created vast wealth through real estate, through constantly building up these properties and this income, who get up in front of your audiences and go from A to Z, explain every bit of it using real numbers, real examples. And it's just absolutely amazing, and I find so valuable because, as you constantly stress, anybody can do this. It's not rocket science. It's a few basic concepts, and then being careful in the application.
Yeah, absolutely. I mean, I think the thing that we have in common, and I've learned a lot at your conferences too, Brian, and the reason we started attending was primarily as students, is, first of all, that we want to invest in things that are real. And so I call it real asset investing, and I took it a step further, calling it strategic real asset investing, because you can do portfolio strategies using real assets. So you don't just have to use paper assets like stocks, bonds, ETFs, mutual funds, futures, all of those things. I'm not saying you don't have some of those things in your portfolio. You just have to understand almost every single one of them has a counterparty risk. And as we found in 2008, when counterparty risk rears its ugly head, it is a mad dash to the exit, and it's a daisy chain reaction that takes mega institutions down faster than you can turn around. And so if you want to insulate stuff from that, you have a big chunk of stuff that's real in your portfolio. And the tie-in is that, real estate, if you think about it, is the ultimate resource. It's where timber comes from. It's where oil comes from and energy. It's where food comes from. And so as we got more into understanding that real estate was more than just, people living in it, you could have farms and, you could sell commodities all over the world, or you could pull energy or water rights. There were so many different things you could do with real estate. We thought, we really need to understand commodities. We need to understand mining. We need to understand how these things overlap. There are people out there, brilliant speakers like the speakers you have at the New Orleans conference, that have studied this industry and really know it. And in our world, when we were only in the real estate space, everybody was just talking about tenants and toilets and, how to do all that, which is, it's an important part of the business. But real estate is so bigger than that. And of course, and then we opened it up to understand international. And we've spent a lot of time with people that are international investors. You have Doug Casey's been out at your conference many, many times. And Simon Black is a guy that, we have speak at our conference. And, these are guys that invest all over the planet. And they have opened their mind up to understanding that it isn't all about one country or one currency or one legal system, but that there are all kinds of people all over the planet. And then there's ways to invest there. And I think the one other thing too that I really enjoy about the commodity side of things is that you don't have to be as precise with the local economy. One of the challenges in real estate investing is you really got to get the local economy right. Mm-hmm. The national averages don't mean anything. It's like, what's going on in this town, in this neighborhood, in this area, in terms of supply and demand and jobs and capacity to pay and all that. And with commodities, what I need to get right, like say farming, for example, I need to make sure that I've got a crop that is durable, that can withstand, weather and shipping. And I've got to pick the geography based on having the right labor pool, the right water supply, the right soil and sun and all that. And there's, farming consultants, just like there are mining consultants who can help you get all that part figured out. But the beautiful thing is when you go to sell the fruit of the land, it doesn't matter if the people are in China, Russia, UK, Canada, the US. It doesn't matter where they are. You don't have to get that part of the economy right. You just have to get the commodity right. And so coming to the New Orleans Investment Conference and learning more about how people who invest in that space do analysis and understand how to know when a commodity is priced well. Because if you can buy a piece of land whose value is derived by a commodity at a time when a commodity is in a slump, you can pick up a bargain and then ride it back up to the top. Of course, underneath it all, you have real estate.
Yeah, and there's, to kind of simplify things, there's a lot of factors, obviously, that are unique to precious metals and mining stocks, and as opposed to the real estate market. But on a very simple basis, the debt, the mountain of debt, the debt loads that we both agree on, that we all agree on, have been created. That necessitates at some point that the dollar is going to be devalued, so that debt is correspondingly devalued. It has to happen. It's the process that's occurred in every similar situation throughout human history. So it's going to happen to the dollar, and it is to some degree already. But when that happens, you get when you get the dollar or the fiat currency du jour, the dominant fiat currency, devalued, then real things appreciate correspondingly. They on a very real basis, they go up as the currency goes down, but they also tend to overshoot. So that's why real estate from that basis, not just on an income production, but also on a relative valuation and on a real asset basis, is an investment that works in that kind of scenario. The same thing with precious metals, and that's one of the reasons that you and Robert have begun to focus more and educate people more on precious metals and mining stocks. One of the reasons, I guess, why you've gotten me to speak at a couple of your events as well. And you actually cover that in your free e-letter. I noticed that not long ago you covered the periodic flash crashes that have been happening in gold and silver, and examine what that implies for all of the financial markets and how real estate stands in contrast to that. Could you expand a bit on that?
Oh, sure. Well, I mean, there's a couple of things. One is, that happened in the paper markets. You and I both know that happened in the paper markets.
Yeah.
And, putting that newsletter out had multiple agendas. One is, I think that every investor who denominates their wealth in dollars, and because the dollar is the world's reserve currency, almost everybody on planet Earth is affected by it. If you don't understand how to pay attention to what's going on with the dollar, then you're going to be at a disadvantage. And obviously gold is an indicator. Gold used to be, currency. Today it's basically money, and currency has been separated from it. And there's so many young people out there who don't even understand what I just said, which is concerning. And so, we want to make sure that people start to just pay attention to the space. The second thing is we wanted them to understand there's a difference between the paper market and the physical market, and the timing on that particular event was interesting. It was 9:00 London time on a holiday weekend, and Ramadan was going on. So Turkey and India were out of the market. The United States market was closed. And, the theory is, or the press says, that somebody with a fat finger, hit a button and accidentally sold $2.3 billion of gold. Now, I can't even delete an email on my computer without, are you sure you really want to delete this? I can't imagine that you can place a $2.3 billion short, with gold you can't possibly have. It was the entire gold reserve of Finland, is what the article I read said. So, clearly this guy had to do this when the major physical buyers were not in the market. And that's what happened. And of course, then he blew out all the stops, and that game went right down, and then he was able to correct his mistake by buying back in, I'm guessing conveniently below those stops. So he flushed the stops. I mean, and my point is A, that these markets are manipulated. I'm not saying that it was a government manipulation, although it's hard to imagine anybody, besides the government having a $2.3 billion, checkbook to be able to pull off that kind of an order. There's very few players in a market could do that. But be that as it may, whoever it was, these things happen, whether they happen by mistake or they happen on purpose. It's just a tough place to be in there trying to create cash flow by churning. A lot of traders are trying to buy low, sell high, buy low, sell high. And it really brings up the bigger argument. It's like, what are you investing for? If you're investing to collect dollars, I mean, think about how crazy that is. Somebody that would buy an asset and then write it up and then sell the asset so that at the end of the round trip, they're sitting there with dollars. All they're collecting is fiat currency. And to your point earlier, Brian, I mean, the ultimate destination of that fiat currency is nothing. It will lose its value. So instead, we should be trading dollars and collecting assets, not trading assets and collecting dollars. And that's just a fundamental shift. And so Robert Kiyosaki, who's a good friend of both of ours, he redefined what an asset is. And he said an asset is something that puts cash in your pocket. Well, that changes the way you look at everything. If I own something that's not producing income, In other words, it isn't a means of production, because income comes from production. So throughout history, if you look at the people who have been wealthy, they are the people who own the means of production. Mm-hmm. It used to be, the land barons. They owned the land, and the production was agriculture. The people who owned the gold mines or owned the oil fields, they became wealthy because they owned the means of production. In the industrial age, the people who owned the factories, like China today, they're wealthy. Why? Because they control the means of production. So as an investor, your job is to own things that produce. And of course, for the average person, I come back to real estate, easy way to do it. Because I don't care what you're denominating productivity in, 30% is about the going rate. 30% of somebody's productivity, gross productivity, goes to you in rent. When you go to rent a property, it's usually about 30% of the average renter's income. It doesn't matter if they're being paid in banana peels, clamshells, dollars, yuan, SDRs. It doesn't matter. It doesn't matter what they're being paid in. 30% of their productivity. So your mission as an investor of any kind is to accumulate the efforts of others. And this is going back to what I said at the top. Fundamentally, when you're trying to buy low and sell high, you're not accumulating the efforts of others. You're just trying to make a round trip of going from, trading assets to collect dollars. And that, I think, is a mistake, because they're not even really assets. They're just whatever they are. And if they're not producing income, they're not really assets, going back to Kiyosaki's definition. So anyway, to me, the gold market, following the gold market, gives me insight into what's going on in the dollar. It gives me insight into what the central banks are thinking, because I'm assuming that they're in there, and I think it's a pretty safe assumption, monitoring, maybe to a degree, manipulating those prices to paint a picture. You look at the divergence between Bitcoin and gold right now. It's hard to manipulate Bitcoin, right? So what happens to Bitcoin? It's going crazy. Whereas gold ends up getting smashed. I don't know. Kind of weird. So to me, just keep it simple. Accumulate the efforts of others. Own means of production, and the easiest way is own rental property. People will go to work for somebody else and send you 30% of their paycheck. The most important thing for any investor to be concerned about is private property rights. Anything that threatens private property rights is even a greater threat than a collapsing currency. Collapsing currencies, whatever. As long as you own things that are real, you're fine. But if you're not permitted to own those things, or your property rights are somehow jeopardized or infringed upon, now you've got a problem. There is no freedom without private property.
And one of the things that fascinates me, and I've learned more and experienced more after speaking at your events, is how much we all have in common, from the attendees at my conference, the attendees at your events, the guests that we have on this podcast. Fergus, you mentioned how we've been focusing recently on the
liberty movement, you might say.
Sure. Yeah, the liberty movement, libertarian philosophy, etc. And you'll find the same thing at the Real Estate Guys events. It's just that they also focus on some real world applications of these philosophies and use it as a foundation to find real world ways to build wealth. And you mentioned that, I have Doug Casey at my events. He's an international investor, well known for that. You have Simon Black at your events, and I'm stealing some of your speakers now. I've got Simon speaking at my event at the New Orleans conference this year. I've got Robert Kiyosaki speaking at my event this year. We're very excited about that as well. And just those two guys, I'm telling you, they are just amazing presenters and completely it gets you to look at the world from a different angle. And once you learn how to do that, you see so many things that escaped you before. And that's, at its base, that's what you guys do with your conferences and your presentations. And I'm just very excited to have you back this year in the New Orleans conference. And we're trying to expand your role, bring your presentations and workshops into the main body of the conference, rather than just like a preview workshop to the event. We're getting you and Robert to be featured presenters, and with a good block of time to really control as you like, and kind of give people a mini view of what you do at your events.
Well, I think you hit the nail right on the head, Brian. I mean, we have so much more in common than we don't. And one of the roles that I think Robert and I have attempted to play and have had a degree of success at is crossovers, bringing people together who, formerly were in their own little silos. And, understanding that we do have a lot in common. And, not to be a conspiracy theorist, but there are, special interests, let's call them, that profit from people's ignorance of some basic concepts. And so a lot of our training, it comes through marketing, and a lot of that marketing is designed to churn accounts and create profits and taxes and so on for the institutions. And the little guy is playing a game that is very difficult to win. Of course, like anything, the people who do well are held up. Hey, if they can do it, anybody can do it. Yes, but the success ratio is very, very low. Whereas, when you stick to fundamental things and you're investing in things that are real, that are simple, that you understand, and you have a degree of control and influence over, it's harder work because you can't sit in your crib with your trading app and move in and out of positions. You have to go out in the real world and look at things and have relationships. So it's not sterile and clinical and convenient, but it's also, you're a lot less likely to wake up one day and have half or 75% of your worth gone, or go to sleep, thinking that you're rich when you're really not. When you look at a system that can wipe out trillions of dollars of balance sheet wealth because of a trading glitch or a national disaster or a political faux pas or pick something, that's a very fragile way to feel rich. I mean, you look at a guy like Kiyosaki that has hundreds of thousands of dollars a month, every month coming in rents. And there's, been crashes and wars and political problems, and you go on and on and on. But, those people just get up every day. If you look around you, people get up every day and go to work. When 9/11 happened, it was, horrible on Wall Street, and people's portfolios were decimated. But every day people got up and went to work, earned their paycheck, bought their groceries, paid their rent, and it was very stable. And that's, as an investor, true wealth is going to be based in things that are real and stable. And so getting people together and helping them see the big picture, part of that enlightenment is just understanding a lot of the things that we've been trained to believe about how to build wealth and what wealth is are false. I think that, folks listening to this, if they've never heard Robert Kiyosaki speak, or even if they think they've heard him or they think they know who he is, I mean, he's a remarkable teacher, and he really does change the way you look at what's going on. I mean, and he's, to me, he alone is worth the price of admission right there.
Yeah, I can't wait to have him at in New Orleans this year and see what he has to say. And you mentioned something just now that you, to invest in real estate, you have to go out in the world. And earlier you mentioned how you have to go out and you look at the individual markets. You guys also do that. I mean, you have field trips to various markets where you intensely study those areas and the real estate opportunities and pitfalls and problems that have to be overcome for those markets. And you've been focusing on Belize in recent years, which has become a very popular Plan B kind of destination for investors who want to have not only real estate income, or income producing real estate, but also someplace they can go and enjoy on a vacation basis, and also have as that kind of Plan B escape mechanism, a place that they go if they have to, if things go to hell in a handbasket, which we all hope doesn't happen. But if it does, you've got it covered. You've got some place to go. Why have you and Robert focused on Belize so much recently?
Well, for us, in coming out of 2008, we recognized that having all of your money, all of your wealth, all of your future prospects tied up in one country, no matter how strong that country, and of course the United States, maybe even today is still arguably one of the great countries to invest in. Great private property rights, strong economy, great natural resources. We sometimes as Americans, we focus on a lot of things that are wrong, but you get around and you see a lot of people are aggressively wanting to move their wealth into the United States because they perceive it as a safe haven. So, but even with that said, 2008 taught us that you can't have all your eggs in one basket. The other thing is we realize that a lot of the things going on in the world would impact the bigger countries first. And so we thought, well, how could we find a place and find a lot of the things that we like to do? Robert loves to do real estate development. So he said, well, how can we do real estate development? Well, you got to find a place where there's room to develop, and we're a small player. So where could we go someplace as a small player and be a big player? And Belize was that for us. We found an island, and if you don't understand the geography, there's the big chunk of mainland which is sparsely populated, and then there's the Keys, which are these little islands. And the largest island is Ambergris Key. It's where 75% of the tourists go, and it's a small island, 3 miles wide, 24 miles long, about half of it owned by the government, and it's beautiful. It's behind the second largest barrier reef in the world, behind Australia. It's one of the great diving destinations, fishing. So it's beautiful, but we look for supply and demand situations that are favorable. And what we discovered in Belize, in this particular island, is that there was a huge shortage of hotel rooms. And the construction technology and labor force down there was completely incapable of meeting the need, couldn't even come close. Well, we happen, and her, our partner Beth is a secret weapon. She's just an amazing real estate developer. So we were able, through a relationship, to gain control of chunks of land down there. And Beth went down there and came up with this amazing design that made sense first for investors, and we call it lifestyle investing. It was something else, right? We've invested in a lot of different things over our career, and ultimately you decide, well, life's too short to just do business with people or be in a space that you really don't find engaging. And so, if we're going to have to travel someplace, where would we like to travel? Well, it's Caribbean postcard beautiful, Corona Commercial, gorgeous place to visit. We said, well, let's build something there, and let's make it make sense for investors by using engineering that creates a high quality product that will rent, overnight rentals, which is very lucrative, and yet be very inexpensive to build, so that there's a high ROI of cash flow for the investor, because it's got to make sense. And so we did that. And of course, you've seen the project down there. We've got probably $60 or $80 million in. We got a long way to go. And last summer, we were able to announce that Hilton brand had been associated with us, and so we literally brought the first major brand into that island. And we've the capacity when we open. We're going to open later this year, and when we open, we're going to be like 10 times bigger than any other hotel there. And so this is what the airlines, this is what the country has needed desperately, was somebody to come in and solve that problem. Of course, the base of entrepreneurship is being able to solve a problem. So in this case, it was very nuanced, because we found a great supply and demand dynamic. We found a market that was on the rise that had a problem which they couldn't solve. And we had the right person to do the job in Beth, and we got down there and we solved the construction problem. It takes them 18 months to deliver a unit. We can do it in about 10 weeks. Nobody's ever seen anything like that down there, how quickly we can construct a quality product. And of course, it attracted Hilton, so now we've got that brand credibility. And so, it started out with us just wanting to have a plan B, a legitimate business offshore, where we earned legitimate business, income offshore, instead of trying to move money and hide money offshore. Let's just earn it offshore, the way some of these other, big companies do. Let's have a place that we'd like to go visit. Let's have it be a profitable investment that we can share with, our investors, and we did that. And so it's just been a win-win-win all the way around. Of course, it's not the only market we're in. That was our second foray. We had done some development in Mexico, but there was some regime changes in Mexico that made it harder to do business with. Belize is the former British Honduras. It's got a British Commonwealth, kind of form of government, very
rule
familiar
of law.
to us.
Yeah.
rule of law, private property rights. Americans can own, foreigners can own real estate. They're very friendly, only English-speaking country in the Caribbean. I could go on and on and on about why Belize is so very, very unique and undiscovered because there was no capacity to get more people there. But now the airlines have figured out, the hotels have figured it out, and fortunately we've been able to become the developer of choice down there. So, we just ended up being, I guess part of it's luck, being in the right place at the right time. Part of it is being smart enough to recognize you're lucky and charge when you have the opportunity.
Yeah.
And so we did that. It's been a fun ride. Beautiful.
But just to clarify for our listeners, what you're talking about is the Mahogany Bay Resort in Belize. And my wife Fran and I visited it a few months back with you guys, and it is nothing short of spectacular. Absolutely gorgeous. What amazes me is the quality of construction, not just the area, which of course is spectacular, but the way that builders here in the States use pine, there they use mahogany. And it's just breathtaking. The locale, the construction, the design, it really is remarkable, and I can't wait for our next visit.
Yeah, it's going to be fun. I'm actually going down there in about 3 weeks. I'm excited about that. And we, Brian, are talking about doing our very first conference in that big conference center we built probably the first weekend in December. So that's not firm yet, but we're talking about it. And if we end up doing that, we definitely would like to have you come speak at it.
Oh, I'd love to.
Russell, yeah, we've actually gone well over time, but people, if you want to learn more about his program, Russell Gray, Robert Helms are the co-hosts of the Real Estate Guys radio show. It's just realestateguysradio.com. Of course, all the links are always at goldnewsletter.com/podcast. So otherwise, we look forward to seeing you at the New Orleans Investment Conference.
But yeah, I'm looking forward to New Orleans. It's been great. I've learned so much every time I come there. You always have great speakers. You put on a great show. Your staff is superb. Emily, Tracy, they're just fabulous. So congratulations, Brian, on keeping the thing going. And I'm hoping with everything going on in metals and mining, that the conference will continue to grow and have great success. And excited about seeing Robert and Simon there too.
Yeah, it's going to be a big one this year.
Excellent, guys. Thanks so much.
All right, thank you.